Hey everyone, welcome back to Corporate Dakota, the place where we break down those thick financial documents like a hot knife through butter. And this time we're diving into Cohen and Steers Realty Shares Inc.'s latest report. You know, the kind of report that usually puts people to sleep, but we're here to find the pulse of the real estate market through their eyes. Before we jump into the numbers, if you enjoy getting these financial mysteries solved in plain English, make sure you're subscribed. And hey, we've got a great community over on Discord, linked in the description below, where we dig even deeper. Alright, so Cohen and Steers Realty Shares is giving us a look at their performance for the 6 months ending June 30, 2025. And if you think it's just a boring recap, think again. We're looking at how they navigated the market, what drove their returns, and crucially, where all the money is going. They deal with real estate investments, which means they're tied to the pulse of property markets, interest rates, and pretty much everything that makes the economy tick. First off, the report is all about Cohen and Steers Realty Shares Inc. and it covers the period from January 1, 2025 to June 30, 2025. They tell us they've got this QR code to find more info, but we're going to simplify it for you. They also mentioned cost of a 10.00 investment, and for Class A shares, it was about $58 over 6 months, which when you annualize it works out to around 1.5% shares. It was about $58 over 6 months, which when you annualize it works out to around 1.15%. That's essentially the cost of having your money managed by them over a year. Now let's get to the juicy part, the performance. For the Class A shares, they saw a total return of about 4.31%. That sounds pretty darn good, right? But they also compare it to their benchmarks, the linked index, which returned a higher 6.2 index, which returned a higher 6.20%. So while they did well, they actually underperformed the S&P 500 in this period. They say an overweight in telecommunications helped them do better compared to their specific real estate index, the linked index. Basically, they bet more on telecom companies, and when those companies rallied due to lower interest rates and a better outlook for tower companies, it boosted their performance. Stock selection in healthcare also paid off, especially with Welltower, which manages senior living facilities. Apparently, the real estate equities whose shares dropped and redeemed for not investing in certain companies like Alexandria Real Estate Equities whose shares dropped. On the flip side, not having enough in freestanding retail companies, another sector that did well because it's sensitive to interest rate changes, hurt their relative performance. They also mentioned stock selection in specialty REITs, or real estate investment trusts, wasn't great. One example they give is Iron Mountain, a company dealing with information storage, which saw a slight dip due to worries about government digitization. So even though they picked some winners, there were also some strategic misses. Let's look at the growth of a hypothetical $10,000 investment. Back on July 1, 2019, let's say you invested $10,000 in Class A shares. By June 30, 2025, that investment would have grown to about $13,438. That's a decent return over 6 years. Over a 5-year period, Class A shares returned about 8.1% without sales charges. And that's pretty good. However, compare that to the S&P 500, which averaged a much higher 16.64% over the same period. So while they're doing okay in the real estate sector, they're not keeping pace with the broader market. Let's check out some key stats. They hold 39 different real estate companies. That's not a huge amount, which makes sense for a sector-specific fund. Their portfolio turnover rate was 14%. This means they bought and sold about 14% of their holdings over the year, which is relatively low, suggesting a more buy and hold strategy, which is often good for cost management. Okay, the big question, what exactly do they own? Kicking off the top 10 holdings is Welltower Inc. at a whopping 10.9% of the fund. This is a significant chunk, showing they really believe in this healthcare-focused real estate company. Then comes American Tower Corp at 8.4%. These are two major players in their portfolio. Digital Realty Trust Inc. is also a big one at 8.2%. It's clear they're concentrating their bets on these large real estate giants. Looking at their sector exposure, 18.3% is in telecommunications, which we heard helped them. Makes up 11.7%. It's interesting to see these sectors performing well, and it makes sense they'd be leaning into them. And in terms of geography, similarly, all their investments, 99.2% are in the United States. This means they're really focused on the domestic real estate market. Now let's look at how they made and spent money over the 6 months. They earned about $114 million in dividend income. That's the money coming in from the properties they invest in. Expenses, however, were around $33 million, which includes investment advisory fees, distribution fees, and other operational costs. The net result was about $81 million in net investment income. They also had a net realized gain of about $52 million, meaning they sold some investments for a profit. On top of that, the unrealized appreciation on their investments, meaning the value of what they still hold went up, was almost $92 million. So in total, their net increase in assets from operations was a healthy $326 million. Looking at the changes in their net assets, scroll net increase, decrease in net assets from fund share transaction scroll from issuing and redeeming shares. They saw an increase of about $470 million. This means more money came in from new investors than went out from those selling their shares. Let's dig into the per share data. Scroll, class of scroll for Class A shares. The net asset value per share at the beginning of the period was $65.79. By the end, it had grown to 67 period, or their total return for Class A was 4.31% for this 6-month period. Looking at Class C shares, their net asset value started at $65.52 and ended at $67.49, a total return of 3.98%. For Class I shares, which typically have lower expenses, the net asset value went from $65.74 to $67.62 with a total return of 4.46%. Then we have Class L shares with a net asset value that moved from $65.76 to $67.64, giving a 4.45% total return. Class R shares saw their net asset value go from $65.96 to $67.84 with a 4.24% total return. And finally, Class C shares, the ones with the absolute lowest expenses, saw their net asset value rise from $65.90 to $67.79 with a 4.49% total return. It's clear that the expense ratios do make a difference, with Class C and Class I performing slightly better due to lower costs. Let's touch on expenses. For Class A, the total annual operating expenses before any fee waivers were around 1.18%. After waivers, it came down to 1.15%. This shows the fund advisor is making an effort to keep costs down for investors, which is a good sign. Class C shares are a bit higher at 1.80% even after waivers. Class I and L shares are much more efficient at 0.80%. A bit higher at 1.8% even after waivers. Class I and L shares are much more efficient at 0, a bit higher at 1.80% even after waivers. Class I and L shares are much more efficient at 0, a bit higher at 1.80% even after waivers. Class I and L shares are much more efficient at 0, a bit higher at 1.80% even after waivers. Class I and L shares are much more efficient at 0.8 at 1.80% even after waivers. Class I and L shares are much more efficient at 0 waivers. Now let's put on our Warren Buffett hat and analyze. Cohen and Steers Realty shares seems to be doing a decent job navigating the real estate market. They picked some strong sectors like telecommunications and healthcare, which paid off. Their top holdings, Welltower and American Tower, are solid companies, and concentrating on them makes sense if you believe in their long-term prospects. However, the fact that they're underperforming the broader S&P 500 in this period is something to note. It highlights that sector-specific funds can sometimes lag when the overall market is booming or when they miss out on the broader market's winning sectors. The report also mentions that a large shareholder or several large shareholders investing through a single financial institution could impact the fund's performance due to potential large redemptions. This is a general risk for many funds, but it's worth keeping an eye on. It means a big chunk of money moving in or out could force them to sell assets at a bad time, affecting everyone. Overall, Cohen and Steers Realty shares is a focused fund on real estate, and their performance in the first half of 2025 was solid within their sector, but lagged the broader market. The key takeaway is that while they're managing their portfolio well, understanding the sector they focus on is crucial for your investment decision. If real estate is your game, they seem to be playing it competently. Alright, that's our deep dive into the Cohen and Steers Realty Shares report. What are your thoughts on their performance and strategy? Let us know in the comments below. If this breakdown helped you understand complex financial documents better, give this video a thumbs up and subscribe for more. And don't forget to join our Discord community through the link in the description for even more insights and discussions. Thanks for watching Corporate Decoder. See you next time.